let's, revalue gold, buy a bunch of Bitcoin with the revaluation proceeds, excuse me, and then we can sell our gold and we can rug pull the Chinese and the Russians with all the gold they've bought. And that's fine. In theory, that works, but there's always a second side. There's always a second side of the ledger. There is always what next that one has to consider. And what next in this case is China would go, oh, okay, the price of rare earths is now 2 Bitcoin a pound. So in my opinion, they will continue to go to gold. And it's in the U.S.'s interest for them to go to gold, for the U.S. to reshore, rebalance everything we say we want to do. End of the day, dollar's got to be way, way, way lower, way lower.
Rising geopolitical tension, accelerating currency debasement, and the strategic positioning of global powers continue to reshape the monetary landscape. Beneath the surface, the contest is not simply about reserves or interest rates. It is about which nation can maintain productivity, secure resources, and navigate a world moving toward a structural reset. These shifts make the next phase of global finance dependent on understanding trade incentives, capital flows, and the limits of debt-based systems. Luke Gromen, a longtime macro strategist focused on sovereign debt, currency structure, and global power transitions, breaks down why the United States faces a narrowing set of choices. He explains that attempts to weaponize gold or Bitcoin against rival powers would backfire quickly, as resource-rich nations could reprice critical materials overnight. Proper leverage, he argues, lies in productivity, an area where China currently holds the advantage. Gromen highlights that a major war remains unlikely because the U.S. cannot sustain conflict without the very supply chains it seeks to counter. Instead, he sees a financial reset ahead, one that forces the U.S. to accept inflation, restructure incentives, and rebalance domestic productivity. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Let's, revalue gold, buy a bunch of Bitcoin with the revaluation proceeds, excuse me, and then we can sell our gold and we can rug pull the Chinese and the Russians with all the gold they've bought. And that's fine. In theory, that works, but there's always a second side. There's always a second side of the ledger. There is always what next that one has to consider. And what next in this case is China would go, oh, okay, the price of rare earths is now 2 Bitcoin a pound. Have a good day. And just like that, the Bitcoin would have flowed back to China, replacing the gold. And so it really comes down to who's the most productive. And that is why it's so important to invest for both of these sides, investing in AI, robotics, etc., as they are. And who's going to win that productivity contest? And gun to my head, China's winning it now, in my opinion, based on what we're seeing. And you can, and I say that not because I'm I have a bias, but listen to what the China hawks are saying. Listen to what they're whining about. Oh, China's producing so much, so cheap. Translation: China's more productive than the U.S. It's that simple. Next question from N. Based on everything that you're forecasting about gold, dollar, bonds, etc., how likely is a major war, and when is it most likely to happen, if at all? In my opinion, it's very low probability. The U.S. has empirically been shown that it can't go to war without Chinese supply chains supporting it, and that's a problem because, in theory, a major war would feature the U.S. and China on opposite sides, or the U.S. and Russia on opposite sides, with China picking one side or the other. And to paraphrase, I believe it was Patrick Henry who said it in the U.S., if we don't hang together, we shall all hang separately. The U.S. has made it abundantly clear to Russia and China that if they don't hang together, they will surely hang separately. And so agree with those analysts that say Russia and China do have some long-standing issues between each other throughout history, that it's not all sunshine and roses in that marriage, that it's a marriage of convenience. And yeah, sure. And so was the US's and Stalin's in the 1940s, wasn't it? Until our mutual enemy was dispatched. So I think it's a little bit of the same type of dynamic where they both know, they will both surely hang separately if they don't hang together. So given that, And then given what I'm seeing in terms of how quickly and effectively we are decoupling from China, we hear lots of people saying lots of things around rah-rah and cheering it, but I'm still seeing billions of dollars invested in gambling markets. Prediction markets, sports gambling. We're putting billions of dollars into sports gambling while our industrial base and grid still lags China's. And so if we were really moving towards some sort of major war, you would be locking down the bond market, you would be locking down these sources of capital, you'd be redirecting them into something a bit more productive than sports gambling. And so what that really means is you can't go to war without capital controls. And capital controls on the post-$71 system ends the post-$71 system as structured. And so I continue to believe there will not be a major war. I continue to believe there will be at some point some sort of major financial reset. I think it will be inflationary in the U.S. I think it will ultimately be very good for the U.S., but it will be a reversal of sort of relative winners and losers of the last 40 years. From what are the macro implications for the next few quarters and years if the U.S. administration does not outright embrace inflation, but instead continues attempting to rebuild the industrial base without addressing the American middle class wage issues via H-1B visa issuance, gaslighting about food being cheaper, etc. To be blunt, it means the U.S. will not be successful at rebuilding and reshoring because there will not be enough labor to do it. The inflation of labor, the inflation that we need to see is a feature, not a bug. It is a economic signal incentivizing the movement of capital to where it needs to be. And if it is met with H-1B visas, if it's met with wide open immigration, if it's met with wide open college tuition acceptance or college admittance, basically all you're going to be doing is hurting the living standards of a lot of the administration's base on a real basis. And the administration will suffer a big loss come November in midterms, and that'll be that. And so I let's see what they do. But that's my view. From TM, why is there zero correlation between U.S. Treasury supply, i.e. bond issuance, and long-term interest rates going back 100 years? Well, two reasons. The first is because for a lot of that time, we were under a fixed price gold standard. And under a fixed price gold standard, you have to realize sovereign debt has no default risk because the government can always print the money. And so sovereign debt really has only inflation risk. And if you have inflation risk, when you're on a fixed price gold standard, when the government starts to inflate, interest rates don't necessarily need to skyrocket much, much higher, but rather the gold starts to move, right? You get people showing up in the US in the 70s going, give me my gold, give me my gold, give me my gold, give me the gold. And so the movement of gold reduces is the release valve, of the risk of if there's too much treasury issuance, if there's too much inflation, if their deficits are too big. That gets you to the second reason. Once you go off a fixed price gold standard, post 71, then anytime the debt gets too high, your dollar's devalued. So the bonds lose money on a real basis rather than on a nominal basis via higher rates. That's how bonds would lose money. So that's the reason for it. And so, it's important to understand you're going to lose on a real basis. That's why you're going to pay it every dime you're owed. But the government's not going to be starved because rates move higher. They're just going to devalue your currency.
Rising volatility across currencies, debt markets, and global supply chains is revealing a more profound structural shift. Liquidity signals are becoming clearer while the leverage beneath the Western financial order is growing more fragile. The behavior of the dollar, Bitcoin, and volatility indices increasingly reflects the availability or disappearance of real liquidity, shaping when risk assets can rise and when defensive positioning dominates. At the same time, geopolitical strain is exposing industrial weaknesses that have long been hidden behind financial supremacy, especially as the West struggles to supply allies in real time. The erosion of manufacturing depth, the long-term impact of dollar-based Dutch disease, and the growing preference of global creditors for gold over long-term bonds point toward a reshaping of capital flows. As nations reduce exposure to U.S. debt and shift toward hard settlement, the dollar must weaken to rebalance the system and support domestic rebuilding. Let's get back to the interview.
What are the best liquidity indicators you follow to determine if the market's likely to be in risk-on mode when stocks can be bought? I'm watching a lot of different things. The U.S. dollar index is one. Bitcoin is obviously is actually a very good liquidity indicator. I think it's one of the last remaining functioning smoke alarms of liquidity. The move volatility index, certain times interest rates. It is not so much a science as it is an art. But if I had to just look at a couple, I'd be looking at dollar. I'd be looking at Bitcoin. I'd be looking at the move volatility index to see kind of where we are in terms of liquidity or illiquidity and for big moves in those things. From WF, why can't the combined economic power of the West keep the lights on in Kiev? It's a question in reference to comments that Secretary of State Rubio made a couple weeks ago, in which he essentially he said that we've been trying to give defensive weapons to the Ukrainians, but essentially every time we give those weapons to them to defend their electric grid, within a few weeks those weapons are destroyed, and that this has been the case for several years. Rubio's words, not mine. I will answer your question, WF, using the famous scene from the 1992 movie A Few Good Men. This, in particular, the scene where Colonel Jessup is asked by Tom Cruise's character. Colonel Jessup played obviously by the great Jack Nicholson. Tom Cruise asks Jack Nicholson, "Colonel, you gave the order that Santiago wasn't to be touched, and your orders are always followed. Why was Santiago in any danger at all? Why did he have to be transferred off the base?" And the "you can't handle the truth" answer to this question is because the combined economic power of the West, to use your words, WF, is measured as paper U.S. dollar dominance and financial U.S. dollar dominance. But that paper dollar dominance has resulted in the hollowing out of the U.S. defense industrial base to such an extent that the U.S. cannot keep the lights on in Kiev because Russia is taking out the NATO weapons defending Kiev's grid within days or weeks of those weapons arriving. And it takes years for the U.S. to replace those weapons because the defense industrial base has been so hollowed out by U.S. dollar Dutch disease, by the dollar system. And so if it takes us years to replace equipment that it takes the Russians days or weeks to wipe out, once it arrives in Ukraine, how many more weapons are you going to offer? You're going to get what we've gotten here in recent weeks and months, which is trying to secure a peace deal, and you're going to get the Secretary of State admitting this stuff gets blown up within weeks of it getting there. And so we're trying to figure out a solution. This has been known for a lot longer than just the last 6 months, by the way. This has been known for 2-3 years. So, it is what it is. But it's a logistics issue, and it's a logistics issue that ultimately traces back to U.S. dollar Dutch disease. We are the Saudi Arabia of dollars. We're really good at making dollars. And that has eroded our ability to make weapons for our allies and for ourselves in anything resembling a timely manner in anything above very low intensity combat. Final question is from AA. Please explain your thinking as to why you think reshored American trade surpluses cannot be stored in treasuries or U.S. dollars. Because they're not American trade surpluses. They are Chinese, Japanese, German, Korean, OPEC trade surpluses invested in our capital markets. And so if that capital is sitting here and then the U.S. is also going to sell treasuries to buy critical minerals, as we've been seeing, or to reshore and rebuild capacity to compete with these nations and to reduce American deficits with them, then rebuilding that capacity is going to be inflationary, right? If offshoring the capacity was disinflationary, it strains credulity to think reshoring it's also going to be disinflationary. It's going to be inflationary. There's no question. And so when it's inflationary, that's bad for these bonds right off the top. So it is not in these countries' interest to continue to hold long-term treasury bonds in the United States, as they're inflated as we reshore. But number two, from a trade flow perspective, we're going to be competing with them. Our deficit's going to be shrinking, and it's not in their interest to do that. They're going to switch from treasuries into gold. They're going to net settle in gold, and that's what they've been doing. You see it at a central bank level. We've been seeing it at a central bank level, and I think it's going to continue. So it also brings up sort of the bigger question, right? There's always a ledger. The U.S. has been running a current account deficit, trade deficits, right? Trade deficits, fiscal deficits, and a capital account surplus. Yet we're hearing people say, well, now we're going to get much closer to a current account flat, but we're still going to have this giant capital account surplus. No, that's not how it works. It has to balance. And so, people say, well, we're going to get Japan to invest $550 billion in reshoring. Okay, great. With what? Are they going to sell $550 billion of assets they own here in our capital account in order to fund factories to reduce our current account? Or are we going to give them swap lines, basically turn that all into collateral, with the capital account into collateral to invest on the other side of the ledger? And that's just QE. That's just Fed balance sheet expansion. That'll weaken the dollar. And that certainly can be done. But again, if we do that and the dollar weakens, that's going to be inflationary and go back to sort of square one, which is how many long-term treasuries do you want to hold as the dollar gets meaningfully weakened to reshore here? The answer is you don't. And you can't. So from a national security imperative, because if those treasuries buy you a lot less stuff, if you are, say, China, all of a sudden you have you've reduced ability to import goods, becomes a national security threat. If you're Russia and the real value of your commodity, of your FX reserves, get reduced by inflation, that's a matter of national security. It's basically stealing other nations' FX reserves. So that's why they're going to gold. So in my opinion, they will continue to go to gold. And it's in the U.S.'s interest for them to go to gold. For the U.S. to reshore, rebalance everything we say we want to do. End of the day, dollar's got to be way, way, way lower.
The global system is entering a phase where liquidity signals, industrial capacity, and geopolitical leverage are converging into a single narrative. The financial architecture built over the past 50 years is running into constraints that can no longer be hidden behind policy language or market optimism. The indicators that once quietly tracked liquidity, currency strength, volatility gauges, and alternative monetary assets now reveal sharp swings that reflect a more profound structural imbalance. At the same time, decades of offshoring have weakened the industrial base that once supported Western resilience, leaving critical supply chains dependent on geopolitical rivals. This tension is now visible in the difficulty of replenishing advanced weapon systems, the stretched timelines for defense manufacturing, and the growing fragility of national security frameworks. What emerges is a landscape where the dollar's financial dominance no longer guarantees strategic capability. Liquidity injections and market support can sustain asset prices, but they cannot rebuild industrial output, nor can they offset the inflationary pressures unleashed by reshoring efforts. As global partners transition their reserves toward hard assets and reduce exposure to long-term debt, the foundation of the post-1971 settlement model is being questioned in real time. Capital flows are shifting, trade balances are recalibrating, and long-term bonds are losing relevance as a store of value for surplus nations seeking protection rather than yield. This transition does not unfold through dramatic announcements, but through steady structural adjustments, revaluation pressures, rising commodity constraints, and increasing demand for settlement assets beyond the reach of policy intervention. It is a recalibration of incentives where productivity, resource control, and tangible collateral regain primacy over paper claims. The direction is clear: a lower dollar, a reshaped industrial strategy, and a global shift toward tangible assets as the next phase of financial realignment takes hold. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.